Gita Gopinath, Professor of International Studies and Economics, Department of Economics, Harvard University. Distinguished ladies and gentlemen, good evening and welcome to this 33rd edition of Exim Bank's Commencement Day Lecture. We are delighted to see all of you here today. I would like to particularly extend a very warm welcome to our former CMD, Ms. Tarjini Vakil, who was very much a driving force in the institution of the Commencement Day Lecture Series. I'm also delighted to welcome several members of our Board of Directors, past as well as present, many of our former senior staff who are here with us today. It's always a pleasure to meet the wider Exim family. As many of you would be aware, the Commencement Day Lecture Series was instituted in 1986. This is a part of Exim Bank's endeavor to create a climate of dialogue and information search on issues of international trade, investment, and issues that have a bearing on these two particular subjects to advance both general learning as well as specific topic-based learning in both these fields. Over the past 33 years, the Exim Bank Commencement Day Lecture has become an institution in the Bombay calendar, though the dates change from time to time depending on the convenience of the speaker. Last year, we had the honor of having Professor Barry Eichengreen, the George C. Pardee and Helen N. Pardee Professor of Economics and Political Science at the University of California in Berkeley, who delivered the 32nd Commencement Day Lecture on the topic, Capital Flows, What Do We Know? This evening, it is our honor to have with us Professor Gita Gopinath, who has had an illustrious career as a renowned academician and economist, particularly in the field of international economics and finance. Given her vast experience and background, it would indeed be a rewarding experience for us today to listen to her speak on the topics that she has chosen is extremely topical and important today, that is dollar dominance in trade, facts and implications. Since the good old days of David Ricardo and comparative advantage, it has been more or less accepted globally that trade and the growth in trade is very much a good. It has been accepted sometimes willingly, sometimes grudgingly, but it has been accepted none the same. This has led to institutions like the WTO, the various rounds of negotiations which have led to a continuous growth in international trade, which over the past 30 years and more has in fact outpaced global GDP growth. This trend now, however, seems to have been coming under some amount of threat. There is an increase in political populism, narrow vested interests which are triumphing perhaps over the global good. The very premise of free trade as generating a vastly greater number of winners as compared to a limited number of losers now appears to be under question. Never mind that the question is innocent of any evidence and much logic. Protectionism too is beginning to rear its ugly head once again. There appears to be a sense in part, if not much, of the developed world that they may be losing out some of their prosperity, relative or absolute, to the developing world on account of increasing trade. And this perhaps has triggered an appetite for this kind of protectionism. The post-financial crisis global economic slowdown has challenged many of the existing paradigms in economics, and its aftermath has inspired the emergence of many new ideas on international economics and international macroeconomic policy. Some of these ideas, for example, controls on capital movements, taxes on capital movements, have been discussed over the years at some length. Today, the focus is on a set of issues which are relatively new, both in terms of empirical evidence and theory. The theme chosen by Professor Gopinath, that is highlighting the paradigm of dollar dominance, its effect on trade, and its impact on global economic policy. For more than half a century now, the US dollar has been the world's dominant currency in terms of trade, dominant currency in terms of the composition of national foreign exchange reserves, and in many cases, the dominant currency in terms of international financing as well. Private companies use it for international transactions, banks use it for international lending, and so on. It's important for us to understand this paradigm correctly, as it enlightens us on several fundamental questions in international economics. I am sure that Professor Gopinath would shed more light on these pertinent issues related to dollar dominance in trade this evening. While Professor Gopinath is well known to many of us present in this August gathering, may I, for the benefit of those few others who may not be fully aware, highlight a few aspects of her illustrious career. Professor Gita Gopinath is the John Zwanstra Professor of International Studies and Economics at Harvard University's Department of Economics. She is also a co-director of the International Finance and Macroeconomics Program at the National Bureau of Economic Research and a member of the Economic Advisory Panel of the Federal Reserve Bank of New York. Professor Gopinath is also a visiting scholar at the Federal Reserve Bank of Boston. She is currently the co-editor of the American Economic Review and the Handbook of International Economics. Earlier, she was the managing editor of the Review of Economic Studies. Nearer home, she also serves as the economic advisor to the Chief Minister of Kerala. Professor Gopinath has also served as a member of the Eminent Persons Advisory Group on G20 matters for the Ministry of Finance, Government of India in 2013-14. In 2011, she was chosen as a young global leader by the World Economic Forum. In 2014, she was named as one of the top economists under 45 by the International Monetary Fund. Her research work mainly focuses on international finance and macroeconomics, and in these days of Google, I don't think I need to list out any of her publications. Many of them are well known to all of us. Ladies and gentlemen, it is indeed a privilege for me this evening to welcome Professor Gita Gopinath to deliver the 33rd Commencement Day Annual Lecture. I am sure all of you will find this of extreme interest, and we all look forward to listening to her. May I now request Professor Gita Gopinath.
Somewhere. So, thank you. Can you hear me? Is it clear? All right. Thank you. It's a real pleasure to be here, and it's an honor to be here and to give the 33rd Commencement Day Annual Lecture for the Exim Bank of India. And I want to especially thank the Managing Director, Mr. David Raskina, for inviting me to give this talk. So I was told that this is an intellectual event, so I decided to speak on a body of work that I've done over the last several years that I think is important to kind of a better understanding of international trade and international finance. And so that comes under the title of Dollar Dominance in Trade, Facts and Implications. Okay, so it's been 10 years, around 10 years since the global financial crisis, and a lot of paradigms have shifted. There's, questioning of the way markets work, and we've learned a lot, and there's been a lot of impact on policy making that will continue to reverberate for the many years to come. So today what I'm going to do is I am going to challenge one very long-standing paradigm in international economics. And my hope is that at the end of this lecture, that you might see the world through a different lens rather than the one that you've kind of carried in your head and that you've worked with for a long period of time. So this is going to be in the space of international trade. And like I said, I'm going to start by challenging a paradigm. So this is going to sound, this is the Mundell Fleming paradigm. If you've never taken a class in international economics, that's perfectly fine. But that's one of the first things you will learn if you do any bit of international economics is you will learn what's called the Mundell Fleming paradigm. Okay, so even if you've never heard what the Mundell Fleming paradigm is, it is what is in your head, and I would say most practitioners, most policymakers, it's what they carry in their head as the relevant paradigm when they answer questions along the following lines. So if somebody were to ask you, how do exchange rate fluctuations impact inflation and trade? You use, even if you don't know what's the Mundell Fleming paradigm, the way you respond to it will be exactly based on the Mundell Fleming paradigm. So let's take that question, how do exchange rate fluctuations, I'll come back to that. So how do exchange rate fluctuations impact inflation and trade? Secondly, what exchange rate policy should emerging market central banks adopt? Should they have a fully floating exchange rate? Should they move towards a pegged exchange rate? Should something in between, like a managed float like India has, is that the relevant policy? Or take another question, which is how does monetary policy in the US transmit to the rest of the world? So these are all big, important questions that constantly come up at every point in time. And there's a particular lens through which you answer that question. So let's take the first question, which is how do exchange rate fluctuations impact? Let me actually give you a roadmap first before I do that. So this is my roadmap. My roadmap is that first before talking about what's wrong with the paradigm, I'm going to tell you what the paradigm is, so you know what that is. Then I will go into what we see in the empirical evidence and why is it that researchers like me have questioned this paradigm. And then we're going to substitute it with what I'm going to call the dominant currency paradigm, which I think is a much better lens through which to look at the world. And I'll talk about what the policy implications are of the dominant currency paradigm. Okay, so let me first start with telling you what the paradigm is all about, the Mundell-Fleming paradigm. Robert Mundell won the Nobel Prize for this particular paradigm in 1999 for a very good reason. It's a highly influential paradigm. And that paradigm would tell you this, which is that if somebody were to ask you, suppose you're India, the rupee depreciates relative to its trading partners, what are the implications of that for India? This paradigm would say that, well, that should be good for India's exports. India's exports should increase. It should cut back on India's imports from the rest of the world. But there's going to be one downside, which is that it could be inflationary because imports become more expensive in rupee terms, and so that could have an effect on inflation, and that could be problematic. Okay? So that's exactly what the Mundell-Fleming paradigm tells you, and I believe that's exactly what most people would come up with if they were asked, what happens when you have a weaker currency? What happens when a country's currency depreciates? I doubt you will ask too many questions about, which country is it? Is it depreciating relative to the US dollar? Is it depreciating relative to its trading partners? I doubt you will ask whether, is this different if it's the US or if it's China or if it's India? This is a very common set of paradigms that policymakers carry around in their head, and I believe practitioners carry around in their head. So where does this thing come from? Like, why do we have this sense that a weaker currency is good for exports and cuts back on imports and is inflationary, right? You ask, what are the fundamentals? What generates this conclusion? This conclusion is driven by theory, and the theory can be explained in the following way, which is that let's take three countries. You have India, you have US, and you have China, okay? And they trade with each other. The theory that's underlying these conclusions says that when India sells goods to the US, it sets price in rupees, okay? And those prices in rupees don't change around that much. So when the rupee weakens relative to the dollar, it makes Indian exports cheaper in world markets, okay? So that's true when India sells to the US or when India sells to China. The assumption there is that Indian exporters are writing contracts that are in rupees. Those rupee contract prices don't change that much. So when the rupee depreciates or when the rupee weakens, that's going to make the product cheaper in terms of the US dollar for US importers. It's going to make it cheaper in terms of the Chinese yuan for Chinese buyers. And that's why it's going to increase exports to these parts of the world, okay? And on the flip side, if you look at imports from the US, into India from the US, again, the assumption is that when the US sells to India, it sets prices in dollars, and the dollar price doesn't move around that much, which means that when the rupee weakens, it's going to make all imports coming from the US into India more expensive, and it's going to make it costlier. And so they're going to switch it out of imported goods towards domestic producers' output. And so that's going to end up in a cutback in imports, okay? And that works, again, with China. When India sells to China, it sets prices in rupees. The rupee price doesn't move that much. When the rupee depreciates relative to the yuan, Chinese importers are going to buy more because it's cheaper. On the other hand, it's going to make more expensive Chinese goods coming into India because these are all priced in yuan. And what about the US and China? The assumption in this paradigm is this is the way it works, which is that when the US sells to China, it's priced in dollars. When China sells to the US, it's priced in yuan. Okay, now if you're a practitioner and you're an exporter, you will look at a picture like this and you will probably immediately say, this seems a bit odd, because this is not the way India exports to the rest of the world, and it's not the way India buys from the rest of the world. So it kind of doesn't pass the smell test. But once you start with this assumption, then the set of implications that you have follow immediately. All right? So you must remember that when you are making this prediction about what's going to happen to exports for a country, imports for a country, you have this particular paradigm in the back of your head. Or if you didn't know that, you know that now. All right? Okay, and this is, by the way, this is not something just of kind of pedagogical interest or of kind of academic interest. This is what shakes the policy world all the time. So when the US accuses China of manipulating its currency and engaging in unfair trade practices, this is the paradigm that they have in mind, because the expectation is that when the Chinese yuan is weak relative to the dollar, that's going to make Chinese products very cheap in the in the US market, and that's going to flood US markets with Chinese products. It's one of the reasons why there's now a push to have currency manipulation clauses in trade contracts, right? So, in trade contracts, we have the WTO, which prevents countries from engaging in unfair trade practices through tariffs. But then now there's been a push to say, well, the exchange rate manipulation is another form of a tariff, because if I weaken my currency, I'm giving myself an unfair trade advantage. And so maybe in our trade contracts, we should also have a currency manipulation clause, which says that if I look at the Indian Reserve Bank of India and I see that the Reserve Bank of India is accumulating a lot of foreign reserves, that for me is a sign that the Indian RBI is manipulating the exchange rate, and that can be put in a trade contract. Okay? But I mean, it's not just true for the developed world. It's not just the US who complains about this, but developing countries complain about it too. So very famously, Brazil's finance minister coined the term currency wars to refer to this phenomenon where they famously accused the US in 2010 because the US was keeping interest rates very low, the very aggressive, the open, kind of loose monetary policy was weakening the dollar. And then based on that example we just saw, a weaker dollar meant that the US was unfairly shifting demand towards US goods and away from the rest of the world. Okay, so the rest of the lecture from now until the end is going to be to kind of basically break down this paradigm and say that there are many parts of it that don't survive in the data, if you look at the data. All right? So I'm going to give you what the empirical evidence is, and I'm going to contrast that against the assumptions of the Mundell-Fleming paradigm, which is what I showed you in terms of the triangle. Okay, so the first assumption is the fact that, the Mundell-Fleming paradigm works on the assumption that every country, when it sells its products on the world market, sets its prices in its own currency. So when India sells, it sets prices in rupees. When the US sells, it sets prices in dollars. When China sells, it sets prices in yuan. That's the assumption of the Mundell-Fleming paradigm. So you can do this. You can say, well, is that true? You can collect data on export invoicing from different countries in the world, and you can see how much is it that you see that each country is using their own currency in international trade. And what you see immediately is that the vast majority of countries do not use their own currency in international trade. And they rely very heavily on the dollar as their currency of transaction. So for instance, this was a paper that I wrote for the Jackson Hole Symposium in 2015, where what I did was look at data from countries in the world and look at their invoicing and to see how much is it that you see of countries doing their own currency invoicing. What you end up with is you see that the US dollar is used a whole lot in international trade, which means that if you look at, for instance, dollar invoicing in imports in the world, so if you look at all imports in the world, and you look at what currency they're invoiced in, so they could be in dollars, in euros, or in any of the many other currencies in the world, you kind of group them into that. And you look at the US's share in world imports, the ratio of invoicing in imports in the world as a whole divided by the US imports is about 4.7. Okay? So it's about close to 5 times, which means that there's a whole lot of trade that takes place where the US is on neither side of the trade transaction. It's neither the importer nor the exporter. And they're using the dollar as their currency of transaction. Okay? So that was for imports. The same ratio for exports is 3.1. And by the way, this is not just about commodity prices. Now, we all know that commodity prices are quoted in dollars, and you have oil prices and copper prices are quoted in dollars, but this is not that. This is about a whole bunch of other goods, electronics, pharmaceuticals, many other very detailed products in which there is a heavy reliance on dollar invoicing in international trade. Okay? Now you could ask, well, is there any other currency that comes close to the dollar in terms of having this kind of excess representation? And the next currency that you have is the euro. But the euro share is about 1.2 times its share in world imports or in world exports, which basically means, sure, the euro gets used a lot, but it's almost always when there is some euro country on one side of the trade transaction, either as an importer or as an exporter. It's not used otherwise between country pairs where it's not a euro nation on one side of the trade transaction. So there's a big gap between the dollar and the euro in terms of the prominence of currencies in international trade. So look, let me give the specific example of India. India has 86% of its imports are invoiced in dollars, while only 5% of its imports are from the US. All right? So overwhelmingly, everything that India buys is invoiced in dollars, while its trade with the US is 5%. So under the Mundell-Fleming paradigm, the assumption under which you kind of come up with those conclusions, it should have said that only 5% of India's imports are invoiced in dollars because 5% of its imports come from the US. But that's not what this is. This is 86% of its imports are invoiced in dollars, while only 5% comes from the US. Similarly, if you look at India's exports, 86% of India's exports are invoiced in dollars, and only 15% of its exports go to the US. All right? If this was a Mundell-Fleming paradigm, I guess I could give you a quiz. What percent of India's exports should be invoiced in dollars? 100%, right? Because according to the Mundell-Fleming paradigm, everything that India sells on the international markets should be in rupees and not in any other currency. So 100% of India's exports should be invoiced in rupees and 0% in dollars. But that's not the fact. The fact is that 86% of India's exports are invoiced in dollars, and only 15% of those are actually going to the US. This figure over here, and it doesn't matter if you can't see the names of countries at the bottom, but what this is basically comparing is the amount of each country's imports that are invoiced in dollars relative to each country's imports that come from the US. Okay? So this is like India, the calculation for India, 86% imports invoiced in dollars, 5% imports from the US. And so this is for a bunch of other countries. And according to the Mundell-Fleming paradigm, these two bars, the black and the gray bar, should have the exact same height. That's what the paradigm would tell you. But that's not what we see. We see that pretty much across the board, the dollar is used very heavily in transactions with the world where it has nothing to do with the US. These are not goods coming from the US. These are goods coming from other parts of the world. Okay. So once you see this, you kind of ask yourself, it's kind of a bit bizarre why we have this notion that it doesn't matter which country you're talking about, that a weaker currency should be good for your exports, should cut back on imports, should be bad for inflation. There's nothing symmetric about this picture. This is a very asymmetric picture. It's a picture of an asymmetric world. What it tells you is that some countries have very different impact on world markets than other countries do. So in this example, the Indian rupee doesn't show up anywhere. The US dollar shows up everywhere. Now remember, we should expect the US dollar to be important because it's a large economy. It is a big share of world GDP. It has a sizable amount of world trade. But what this is saying is that its influence on international trade is way bigger than any of those factors are. All right? And so here's a table where I give you, for a bunch of countries, their reliance on their own currency in international trade. So for instance, according to the Mundell-Fleming paradigm, it should be that this exports should be for every country, it should be 100%. That 100% of their exports are invoiced in their own currency. That's what the paradigm should say. So if I look at India, that's 0, kind of right at the absolute opposite of the Mundell-Fleming paradigm. The only country that satisfies the Mundell-Fleming paradigm is the US, where 97% of US exports are invoiced in dollars. But what's fascinating is that you can come to a country like Japan, right? Japan, which is a reserve currency, it is a safe haven currency. As you know that whenever there's a crisis, people rush to the yen alongside rushing to the dollar. Only 40% of their exports are invoiced in Japanese yen. The rest are overwhelmingly in dollars, and then some amount of it is in euros. So even UK, which is again a reserve currency, only 50% of their exports are in the British pound. So the dollar is special not just relative to developing countries, it's also very special relative to other developed economies in the world. Okay, so you might ask the question, okay, so what does this picture look like if I were to just replace the figure that I had at the beginning? What it says is that the world looks closer to this, where it doesn't matter which way you are, everybody seems to be transacting in dollars. Now this is obviously a bit extreme, because I showed you there are some developed countries that have a reliance on their own currency. But if you have to pick a paradigm, and if you had to approximate the world with a paradigm, this would be a better paradigm, which is the dominance of the dollar. So this is what we call the dominant currency paradigm, the fact that the dollar gets used very heavily in international trade. Okay, so that's one fact that comes from the data that goes against goes against, very strongly against the Mundell-Fleming paradigm. But you can ask yourself that, it's not that easy. If all one needed to show was to show the fact that there's a lot of invoicing in dollars, that would not turn any paradigm around. Because you could say, well, sure, when India sells to the US, the price the exporter writes on the sheet of paper is in dollars. But effectively, whenever the rupee depreciates, they actually change the dollar price by a lot, cut dollar price by a lot. So it could be that effectively it works like the Mundell-Fleming paradigm, right? So it's not as if the prices are actually in some sense sticky in dollars. They're actually continuously moving the dollar price around when the exchange rate moves around. So that's the much harder paradigm much tougher test to pass. So the next set of results that I'm going to show you, where I'm not going to go into details of it because this comes out of analysis that you would have to spend a lot more time going over carefully. But let me tell you what the basic takeaways are. Is that the takeaway is the fact that it is indeed the case that prices are sticky in dollars. So it doesn't matter. So when India sells to the US, it is not the case that when the Indian rupee depreciates, the dollar prices at which they sell to the US goes 1-to-1 down with the exchange rate. It doesn't move that much. There's some movement, but not much. So it is indeed the case that up to a first approximation, in the short run, which is about a 1 to 2 year horizon, you can say that the prices that everybody's selling to everybody else in the world is a dollar price, and that dollar price is not moving around much at all. Okay? So now if you have that picture in your head, then you can see how that changes our conclusions for inflation. In the following sense, one, you are the US, suppose you're the US, and everything you're importing from the rest of the world is priced in dollars, and that dollar price is not very sensitive to the exchange rate, which means the impact of exchange rate depreciations or appreciations of the dollar on its inflation is very limited, because the dollar price isn't moving. If the dollar price isn't moving, then if the dollar weakens, it has a very small impact on inflation. Think of the extreme case where the dollar price doesn't change at all. then it has zero impact on US inflation. Now flip that around and think of yourself as India. So if you're looking at it from India's perspective, you would say, well, what happens in the case of India? In the case of India, it's completely the opposite, which is that everything India is buying from the rest of the world, 86% of their imports, are invoiced in dollars. That dollar price doesn't move around that much, which means that when the rupee depreciates, or weakens, it has a very high impact on inflation in India. Right? So you have a complete asymmetric effect of an exchange rate movement on India versus the US. So whenever the rupee-dollar exchange rate moves around, it has huge consequences for inflation in India, but it has very limited consequences for inflation in the US. This is a starkly different prediction than you would expect from the Mundell-Fleming paradigm, where it should be completely symmetric. There should be no asymmetry of this kind. And you actually see that in the data. So if you actually estimate the pass-through of exchange rate movement onto inflation, it's weak in the US, and this has a very strong impact on emerging markets. Okay. The other thing that's interesting is that what really matters for emerging markets is not your trade-weighted exchange rate. What matters is your exchange rate relative to the dollar. So even if the US is only 5% of your trade, what matters for your inflation is not the exchange rate relative to all your trading partners, but your exchange rate relative to the dollar. Because if everybody selling to you is setting a price in dollar, the rupee value of that depends on your rupee-dollar exchange rate. It doesn't depend upon all the other millions of exchange rates that you have there. So while it's very standard in policy circles to try to understand the impact on inflation using the trade-weighted exchange rate, the reality is that you're just going to get a more accurate measure if you look at exchange rate relative to one country, which is the US. Second, so this is, might come as a surprise to several of you, which is export expansions following depreciations are weak. I mean, I know that there's usually a lot of push to weaken a currency because the expectation is that that's going to be good for exports. That's going to cause you to export more. There's no empirical evidence that supports that, all right? That in fact, what you see, including after very large devaluations, that the export expansions following a weakening of your currency is actually weak. Now, so think of it, why this makes sense in this world. Think again of the example of the US exporting, of India exporting to the US. So India exports to the US, it sells in dollars, it sets a dollar price. The rupee depreciates. If the rupee depreciates but the dollar price doesn't change much, which is what you see, then from the US buyer's perspective, Indian goods have not become much cheaper. And if Indian goods have not become much cheaper, there's no reason to switch away from other products towards Indian products. Okay? And so that you should not expect to see any impact on exports, at least in the short run. All right? So what does this mean? I mean, is this like now telling us that countries don't want weaker currencies? Does this mean that, okay, maybe we shouldn't be pushing for weaker exchange rates? There is one dimension along which weaker exchange rates are still good for a country. So for an Indian exporter selling to the US, even if they don't sell more in terms of quantity, if you have a weaker rupee, then that's going to raise the per unit profit that you make on what you sell. Right? Because you think about it, the dollar price stays exactly the same. You have a weaker rupee, then that's going to raise your markup, or it's going to raise your profit margin. So that's beneficial. So it's still very much the case that exporters would like to have a weaker currency, but for completely different reasons than kind of the standard Mundell-Fleming logic or the standard arguments people talk about, which is that somehow it's going to boost exports. That you don't see much evidence in the data. And the next point is that the strength of the US dollar, this is also something that we show empirically. I'm not giving you numbers over here, but the strength of the US dollar is a key predictor of world aggregate trade volume and consumer and producer price inflation. So what this is basically saying is that if you live in a world where there's so much of dollar used in international trade, each country's value relative to the dollar has a huge impact on their trade with other countries, where other countries where the US is not on either side of the trade transaction. So it has a huge impact on this. What exactly does this mean? What this means is that in periods when the US dollar appreciates relative to all other currencies in the world, like happened during the financial crises, that would have a negative impact on world trade. Right? Because what this is saying is that if I look at trade between Japan and Mexico, and all trade between Japan and Mexico is conducted in dollars, the prices are in dollars, even if there is no movement in the Japanese yen-Mexican peso exchange rate, the fact that the Mexican peso and the Japanese yen have both depreciated relative to the dollar would induce them to cut back on imports from each other. Because what matters is the fact that that whatever they're importing has become more expensive to them whenever the exchange rate depreciates. So this is again saying that the dollar takes a very central role. So this is again the dominance argument that you have, which gives the dollar, that's where the title comes from, the dollar dominance in international trade, that you end up in a situation where the value of the dollar has a huge impact on world trade, even if its share in world trade is a small fraction of overall trade. Okay, so we can ask, well, so this is what you see empirically, in the data, this seems to be suggesting that's the case, but then you can ask yourself, why is it that everybody's coordinating on this currency, right? I mean, why is everybody doing that? Why is there any benefit to be all using one currency? And the reason comes down to the fact that there are multiple explanations for it, but let me give you a couple. What we see in the world is that most exporters are also importers, right? Which means that when I produce a good and I sell it in international markets, some part of my cost of production involves using imported inputs, right? If those imported inputs, whoever sells to me, is setting a price in dollars, then that makes it more attractive for me to keep my export price also in dollars because that's going to align better my revenues and my costs, right? So that gives you a reason why everybody starts moving towards the dollar. Secondly, if you're in a world where you're competing with many other producers, so suppose you're selling to the US and you're competing with China, and you're competing with Vietnam, and you're competing with Bangladesh in selling to the US market, and if all of them are pricing in dollars, which means what? Which means that the dollar price is not moving around that much for what they sell to the US. If you deviate and start pricing in rupees, then when the Indian rupee fluctuates relative to the dollar, your prices relative to all your competitors are going to move around. And that's not going to be good for you in terms of your market share. So that gives you another reason why you want to keep your prices also in step with your competitors and you want to keep your prices stable in dollars. Now, of course, this doesn't tell you that it should be the dollar. It could be another currency that everybody coordinates on. And so here, of course, it matters that the US has a sound financial system, a sound monetary system. But it also tells you that there's nothing, sacrosanct about the dollar being the dominant currency forever. It could switch to a different currency, and I'm going to come back to that right at the end. Okay, so then let me move on to the policy implications of the dominant currency paradigm. So what does this mean in terms of a takeaway? In terms of policy conclusions, let me just remind you that if you came from the Mundell Fleming school of thought, which is what pretty much everybody has come from up until this point, you would believe the argument that Milton Friedman made, which said that it's optimal for countries to have a fully flexible exchange rate. That would be a prediction. But anyway, let's walk through this and let's see what the policy implications are if, in fact, the world does not look like the assumptions of Mundell Fleming, but looks more like the dominant currency paradigm. Firstly, on inflation stabilization, it's a good rule of thumb. If you want to see how much of a country, how sensitive is a country's inflation rate to exchange rate fluctuations, a good rule of thumb is if you look into the data and you see what fraction of their imports are invoiced in a foreign currency. In India, that's 100%, which means the pass-through into inflation is very high. In the US, it's 0%. The pass-through into inflation is very low. But you can pick another country in between and you can look at the numbers that we have for invoicing, and that's a fairly good rule of thumb. And the reason it's particularly interesting is, I like to flag the experience of what's happening in the US and in the UK. So, as you know, the US is struggling with meeting its inflation target, right? Its inflation target is 2%. Its inflation numbers are in between like 1.2, 1.3%. And they've been struggling to meet inflation. So everybody looks at the US and says, oh, well, this is a developed country problem. You know, it's the Amazons of the world that's causing a problem because you're putting so much of competition, so much of pressure on prices. Prices aren't rising. But then you turn around and you look at the United Kingdom. The UK is way above its inflation target. It's around 3.5% inflation, way above its inflation target. What's different is that in the UK, you had Brexit, you had a large depreciation of the pound, and because UK depends quite heavily on foreign currency invoicing, the pass-through into its inflation has been high. On the other hand, the pass-through into inflation in the US is close to zero in the case of exchange rates. So if you want to understand how different countries seem to be responding, how their inflation has been responding, it's very important to think about the fact that there's a lot of dollar invoicing in world trade. Secondly, in terms of export competitiveness, if somebody asks you next time about if India has a weaker currency, what does that imply for India's exports? Your correct answer would be that the impact on India's exports are going to be very weak in the short run, but it's going to have a good impact on exporters' markups and their profits coming from the margins, higher margins. In the short run, you're going to see very little in terms of exports. On the flip side, actually for the US, a weaker currency has an expansionary impact on exports. But this is the takeaway that you should keep in mind, that it's not at all the case that a weaker currency is going to show up in a country's trade balance improving. So in fact, you could have seen this for the case of Japan. The Japanese yen depreciated substantially after the Bank of Japan went on a policy of monetary easing. And everybody was puzzled by the fact that while export firms and the stock market was booming, profits were going up and markups were going up, you didn't see anything happening with export quantities. Export quantities didn't move at all. Monetary policy spillovers are going to be asymmetric between the US and everyone else. Okay, so what does that mean? That means, so think of this particular thought experiment. Just think of the US and think of India. Suppose that there are inflationary pressures in the US. The US starts raising interest rates. When the US raises interest rates, that causes the dollar to appreciate relative to the rupee, causes the dollar to strengthen relative to the rupee. All right? What does that mean? That means the Indian rupee has depreciated relative to the dollar, has weakened relative to the dollar. That has, through the import channel, has an inflationary effect on the Indian economy. If you are in the RBI, inflationary effect causes you to tighten monetary policy yourself. So you've just gone from the US tightening monetary policy to having the RBI tighten monetary policy. Now go in the opposite direction. Think of India, and if you want to include all emerging markets in that bundle to make it sizable enough. So if emerging markets, and if India thinks that, okay, we have high inflation and starts raising interest rates. Starts raising interest rates, the rupee appreciates, say, relative to the dollar. The rupee appreciates relative to the dollar weakens relative to the rupee. What's the impact on US inflation? Nothing, very little. What does that mean? The Fed has no reason to respond to that at all, right? So the spillovers are very asymmetric. While there's huge spillovers from the US to the rest of the world, the spillovers from the rest of the world to US is very weak, which is why it's very hard to make an argument for coordinating monetary policy when one country kind of is doing quite well without anybody's help. Then about exchange rate policy, like I said, Milton Friedman, because he was viewing through the world through the lens of the Mundell-Fleming paradigm, was of the opinion that countries should have fully flexible exchange rates, and that would be optimal. I'm not going to go into the details of the argument over here because it can be a little subtle, but under the dominant currency paradigm, the wonderful virtues that Friedman talked about of having a flexible exchange rate don't exist. So one of the big parts of the push for having a fully floating exchange rate was that if you have a fully floating exchange rate, when your currency depreciates, you export more. And that, we know, does not show up in under the dominant currency paradigm. And so, in fact, for countries like India, it would make more sense to have a managed float as opposed to having a fully flexible exchange rate. All of this has meant that we can now understand better why there's so much of dollarization in international finance. I mean, think about it. If you think of a whole lot of people buyers in the world who are buying products in international markets that have a price denominated in dollars, that's going to generate a demand for assets that are denominated in dollars. And that demand for assets denominated in dollars will keep US costs of borrowing very low, dollar costs of borrowing very low. So I have a paper on that. It's on my website if you care to look at it. But it tells you basically that these things are very connected. A very heavy reliance on dollar invoicing means that a lot of trade financing is done in dollars, a lot of trade funding is done in dollars, and so this generates a lot of demand for the dollar in international finance. Okay, so I'm going to sum up. So the key takeaway that I want you to keep in mind is that kind of the standard lens through which we think about international trade and therefore policy, it really doesn't work. And it's much better to think of the world through the lens of the dominant currency paradigm. And it's definitely much better for India to think through the lens of dominant currency paradigm rather than the original paradigm in the area. And it's going to be very interesting to see what happens over time. So this is, we're looking at the advanced economies and their share of world GDP relative to emerging and developing countries as a share of world GDP, okay? So around 2008, you had a switching. Now the emerging markets share of world GDP, developing countries share of world GDP, now exceeds the share of advanced economies, and that's projections from the IMF about where we think this is heading. And it looks like we're going to have the so-called emerging developing world is going to be a much bigger share of world GDP than the advanced economy. In this run-up, all of these emerging markets are using heavily the dollar, right? They are not using their own currency in international trade and finance. They're using the dollar. So that has been one of the reasons why dollar interest rates have been very, very low, that borrowing rates in dollars are very low, is because there's a huge demand for dollars coming from all over the world. But then there's a question to ask. I mean, does this change? When you have emerging markets taking over, where does this change? So that's going to lead me to my last slide. And what about the challenges? I was thinking of putting the rupee up there too, but I was wondering whether that was realistic at this point. But the main challenges are the euro and the yuan. And in what sense can you think of them as challenges? So I think what you have to think back is, when is it that the dollar took over from the pound as a dominant currency? Right? So in the 19th century and early 20th century, the pound had exactly the status that the dollar has now. It was used everywhere as an invoicing currency. It was used heavily as a financing currency. And there was a reason for it. It was the biggest economy in the world. It was the biggest source of funding in the world. It had exactly the same variables that the US has right now. And then, of course, you had the US grew. At that time, it was an emerging market. It grew fast. The world wars happened. It switched status. And then now we have the dollar, and the pound is nowhere in the picture. All right? So now you can think, well, now we have the euro area. The euro area as a whole comes second to the US dollar in terms of its share in world GDP. Right? So the expectation was that the euro would be the one that would step in and take over. Then there is also the case that the Chinese yuan is a possibility. China is, for all practical purposes, the largest economy in the world in terms of some PPP numbers. Its share in world trade is huge. And they certainly have an active policy of making the Chinese yuan a global currency. Right? So are we near a tipping point? My take is not at this moment. Interestingly, actually, the euro had some uptake as a global currency, but in the last 5 years, it's actually gotten worse over time. So there's been lesser euro invoicing, there's been lesser use of the euro in international finance. All right? China has a long way to go. It will need to build up its institutions in terms of financial institutions, monetary policy making, full convertibility of the yuan. All of those things still are a far way to go. So this is going to take a long time. And remember that the dollar has a very entrenched system because it's used in international trade, it's used in international finance. It will take a major event to break that equilibrium up. All right? But can it happen? It can certainly happen. And it will happen, and my prediction is that it will happen in a very interesting way, which in the sense that it may not happen for a very long time, but when it does, it will happen very quickly. Just like the dollar and the pound, that for a long time it will look like, the dollar's dominance remains, but then at some point the switch can happen very quickly. So I'm going to leave you with that. And again, just to conclude, I think that answering questions like what's the impact of exchange rates on an economy, how does US monetary policy transmit to the rest of the world, what's optimal exchange rate policy for a country, you kind of need to step back from what I would say is like the most common way of looking at international trade, because I just think that the facts and the data do not support it. And we need to move away and to think of the world more from a dominant currency perspective. There's always been a dominant currency. It was the pound, and now it's the dollar, and can change in the future. But in general, it's a much better paradigm to think of the world, and that has very different implications from a policy perspective. Thank you.
As we step into 2018, and as 2017 draws to a close, we have some very interesting questions. The year 2017 saw global trade grow faster than global GDP after a gap of 2 or 3 years when global trade was even slower than global GDP growth. The other question that has thrown up, that 2017 has thrown up, is that while Indian growth is normally synchronous with global growth, this year India grew below trend, whereas the world grew above trend, that is above the last 4 or 5 years trend. So there are some questions that 2017 has thrown up. We've got experts in global trade here and an expert on world economy and the Indian economy. So we start with some of those questions. Well, first, exactly that to you, Gita. Indian growth has been below trend at a time when the global economy has grown above trend. Is this an aberration, or is this a new normal?
I think it's an aberration at this point. This is partly a consequence of a bunch of reforms that were undertaken in the last year that were disruptive, some in a bad way, some in a good way. But I think as these things iron out, I expect Indian growth to more closely mimic the global trends.
Okay. So what's your estimate of global growth next year? Will it be better than this year? I mean, calendar 2018. And therefore, can we conclude that India will grow better next year than this year?
I think India should actually grow way better than the growth rate of the world. It has a lot of potential. The expectation is that world growth will be slightly higher in the future than it was this past year, because advanced economies and emerging markets have been looking up. So this looks like a very promising year, 2018.
Okay. Well, Mr. Raskina, Indian exports didn't show up as well as world trade grew. That's one of the paradoxes. Our exports always did well when global trade grew faster. This year, the average monthly run rate has been more like $20 to $21 billion. We did have one reading of 26 billion, but largely we have been really subpar. What would you attribute that to?
See, I'd rather than looking at monthly numbers, which don't really give you a trend, if you look at it over a 5-year period, which gives you time to absorb innovations of the last 1 year or so, what has happened is you've really had a price effect. Your biggest export commodity 5 years ago was refined petroleum, which has dropped almost by half. Your biggest import commodity 5 years ago was also crude petroleum, which has dropped by more than half. What you're seeing is really a price effect, because the price of the underlying crude petroleum has dropped. The price of refined petroleum products has also dropped. If you adjust for those two, you'll find it accounts for almost the entire difference, the fall in exports from FY 2013 to FY 2017. So if you look at quantities, I suspect, I don't have the data, but I suspect you won't find that much of a change.
No, I have the data. The quantities, as you say, import and export are affected by crude prices. But I'm not looking at that. If you look at year-to-date export performance, and the year's almost run out, and if you compare it to last year, there is definitely a slowdown in exports, especially at a time when global trade has grown, global economy. Destination countries have grown faster. Therefore, do you see a problem?
A small issue here. Take off the top 5 exports today: gems and jewelry, textiles, chemicals, what would that be? Agricultural products and petroleum products. All 5 are commodities. In none of our top 5 are we price setters. We are price takers, which means we are really responding rather than being proactive. Factor this in with the rupee appreciation over the last year or so. It went from about 67.5 in March 17. It's about 64.5 right now. So you are having an asymmetric effect, and this is probably going to poach on Gita's territory and what she just now spoke. But if you look at Indian exporters, it's asymmetric. Because you are price takers rather than price setters, when the rupee depreciates, there's little or no benefit from a practical point of view, leaving aside the theory. Because very frankly, if you're selling, and you're selling commodities, you're selling, let's say, textiles to Walmart, your Walmart buyer is going to say, hang on, you've got a nice windfall from the rupee depreciation, you better share part of that with me. Conversely, when the rupee appreciates like it has over this year, don't expect that Walmart buyer to share any part of it. So it's actually your rupee strength which is also hurting Indian exports.
Okay. Well, would you agree, Mr. Malik? Actually, in textiles, even the latest month, October, when exports actually grew much better than they did in September, you did see exports of textiles contracting. Yes. Ready-made garments have been contracting for several months now. Would you therefore hold rupee appreciation as the culprit?
Rupee appreciation has definitely been a contributing factor. But much more than that, actually, I think the way the trade blocks have been performing and the way access to market is being determined, that has been playing a very important role. Like, for instance, let's say the emergence of countries like Vietnam, Bangladesh and all on global scenario, with their preferential access to a lot of markets where India really has been out today because the trade blocks have not worked in that way or because they did not have access to those markets. In a whole lot of commodities, I think India is losing out, primarily because it is not in a position to access the market. And India is today, I don't know whether it is design or it is because of the entrepreneurial initiatives, India is moving more towards more value-added engineering products, project exports, project execution, etc. And that trend is taking time to actually take place. I would agree with MD that essentially it is a short-term trend, yes. Over the long-term and medium-term, I think with project exports and higher volume of engineering exports, which India is slowly gaining access to, we will be coming back in a much more manner as a bigger exporter than what we are today.
But just because we will do well in engineering exports and project exports, why should we lose out on textiles? So are you saying this is a Commerce Ministry MEA kind of issue that has hurt India?
No, it's not governmental, not administrative, nothing. It's a very simple thing that when we move up on the destination, on the economic development scale, we become more expensive as a labor input cost. We anyway have not answered a whole lot of our infrastructural issues, which make a difference, like the movement of goods to the ports, like the power availability, etc. So it makes relatively a higher cost structure than a lot of other countries.
Oh, that's a more serious charge.
That's a very
more
serious issue.
Problem.
That is
Gita, where do you stand on this? Is this a productivity issue? I mean, Bangladesh and Vietnam have caught up on productivity and we haven't?
Yeah, so my take on the which looks to me like a cyclical downturn in exports has something to do with the disruption that GST caused. And the fact that it showed up in textiles tells me that is likely. There certainly has been the issue of exporters having paid into the system but not received the refunds back, and there's a liquidity crunch that's come with it. So I think that has been a factor.
Bigger reason.
Now, for the more kind of longer term picture, it's absolutely true that India is not looking very cost effective relative to Bangladesh and Vietnam, and that has to be addressed. And I don't think the value of the rupee in and of itself is going to be such a major driver of how India's exports grow.
But is it that India's been edged out of trade blocks? Any view on that?
Well, I mean, that's for India to kind of edge itself back in. I mean, they should be involved in these trade pacts. I mean, if it's in their benefit, they should be absolutely doing that.
Well, I'll just complete the conversation with getting your comments. Would GST have been the bigger disruptor other than dollar?
Would GST? No. See, any country, if you look at the global experience, there have been several countries which have implemented GST, and all of them have suffered disruptions. GST it's an entirely different workflow, it's a different mindset. There are huge challenges.
There's a liquidity problem, as Gita was
Absolutely.
explaining.
It's
Absolutely.
temporary though. It's temporary.
But separate, yes. But and I think the point came out when Gita was differentiating between short-term and long-term effects. In the short term, yes, you are seeing a disruption. In the long run, you're going to have greater compliance, you're going to have better revenue sources to the central government, you're going to have better data availability. So it's undoubtedly a medium-term and a long-term good.
But I am interested in the short term as well. Is October, just a swallow, or I mean, is it definitely an improvement that we will see in Indian exports?
I wouldn't just say that just October shows the trend.
Okay.
October definitely doesn't show the trend. Just as much as there were aberrations in a lot of Julys and Augusts, there could have been aberrations in October.
Oh, yes.
See, a very fundamental point which Professor Gopinath points out, and that is important, is GST at least has been a disruptor essentially because the system is not yet streamlined the way the working capital flow operates. Companies or exporters have been forced to work with a larger inventory and larger holdings, which has resulted in higher cost of production. So not only the labor productivity, also maybe the overall cost, because the interest overheads and all are also gone up, which might have made our exports
More
outpricing other exports or more expensive.
Strangely,
So-
actually, last year was, the last 12 months have been the years when we have actually controlled inflation, we thought. But in any case, would you say 2018 is a better year for exports?
Yeah, 2018, I definitely look forward to a much better year. And my confidence comes from two sources. One, as I said earlier, I'm a very favorite believer that, yes, Indian exports in future would mean more of knowledge content, more of engineering skills content. So we are increasingly penetrating the market. From my desk in Exim Bank, I see that. The other thing is that GST would automatically also become much more streamlined, leading to lower inventory holdings, lower cost.
Okay, just a quick question. Your exports would be better in 2018, you think?
Absolutely.
Okay. And Gita has already said that GST disruption will be gone perhaps next year and we should do better?
Definitely by the end of next year.
Okay, end of next year. That's still a wait. Well, I wanted to take one more point from what you were, from your lecture. Yes, a stronger dollar need not, a weaker rupee need not necessarily mean our exports will rise. But definitely it means more import substitution.
Yes, it does.
Okay, so
Yes.
that part of the Mundell Fleming theory works.
Yes, you were paying attention. That's right. Absolutely. Where it works, so that there are two sides to the paradigm. One is that exports would grow and you would cut back on imports. What I believe the reality is that you might not see much of an action on exports, but you will see an action on imports. But what's important is what your currency is doing relative to the dollar, which is the important one.
Yes, and that's what we've been discussing. It's come down from 67 to 64. So today it's 64. So clearly some bit of at least a 6% strength or 5% strength. Did you see traces of import substitution because of the rupee strength, Mr. Raskina?
Very frankly, at Exim Bank, we are more focused on the export side.
Okay.
That is our, not
an
so
Exim
much the
bank.
imports. Well, the X comes before the M.
Okay. So you don't think import substitution is a threat because of the strength of the dollar?
See, I don't think, primarily because today the globalization has happened in such a manner that there are many ways in which products could come in from various points of time. You have to improve the overall fundamentals of the economy, the way trade flows, the way manufacturing is made, before you can really say that I am more competitive in this globalized world to be import substituting country. It's not the autarkic world where I was trading with only one country or maybe a couple of countries. So it would be quite a challenge to say that this would automatically lead to more of import substitution.
No, I'll tell you where it leads to import substitution, or at least that's my theory. We have a lot more digitized buying, digital buying. And you could buy anything from toothbrushes to toys on the net. And if your rupee is strong vis-a-vis the yuan, and as a matter of fact, in the last 20 months, the yuan has weakened about 8% more than the Indian rupee has vis-a-vis the dollar. So would not that import substitution have happened?
So again, I think what what matters is what's happening to the rupee relative to the dollar at this point. Now, I know that China is trying to
What happens to the
more.
rupee vis-a-vis the dollar? What happens to the yuan vis-a-vis the dollar?
It-
And therefore, import substitution is possible.
I think it's, yes, but again, it's, and you said that because the rupee is stronger relative to the dollar, that should have an impact on import substitution, not just for goods from the US, but also from China.
Okay. So a plea for weaker currency still holds.
No.
It doesn't hold. Okay. Well, let me pose another question to you on the same issue. October 30th or 31st, at least that's when it was reported, the US Treasury was wondering whether they should impose the charge of currency manipulator on India. How would you react to that?
I think it's crazy. I mean, even identifying a country as a currency manipulator, which is based on reserve accumulation, in my opinion, is bad economics. And so it makes no sense to me, and I can think of many other reasons why countries accumulate reserves that have nothing to do with currency manipulation, besides the fact of, whether a country can actually manipulate its exchange rate in a very persistent way. So no, I think it's very bad.
Okay. Well, so that charge is trashed. I guess this soundbite is going to be replayed several times in proof of India being, a market-based currency. But basically, do you think that the Reserve Bank should have at least one eye cocked on the fact that Indian currency has appreciated? I mean, an inflation targeting monetary policy committee is the big difference between how India had its monetary policy earlier and in the last 12 months. And an inflation targeting monetary policy committee would like a stronger rupee rather than a weaker rupee because its inflation target is under threat when the currency weakens.
Yes.
So do you think the Reserve Bank itself likes a stronger rupee?
Well, it certainly would be consistent at this point in time with keeping inflation in control, having the rupee where it is. But I'm not a big believer in the idea of manipulating your exchange rate to kind of just get it about right, to kind of get your exports up but keep inflation in check. It doesn't work so perfectly. I think the idea of not having wild swings in the exchange rate, which is, I believe, what a central bank should worry about, that's the extent to which you should be worrying about the exchange rate, not so much about micromanaging whether I get the exports right and I get the...
No, you may not get it right, but per se, because you have a monetary policy committee or a monetary policy that is inflation targeting, the Reserve Bank would be okay with a little bit of import substitution. That's not their big problem. They are going to be judged on inflation targeting.
Well, that's fair. Absolutely. I think if you're sitting right with the current numbers that you're looking at for inflation and you want to think of what to do about policy, you cut rates, it's going to weaken the currency, that's just going to make your inflation worse. Okay. And so that is absolutely a concern.
So it could have inadvertently increased import
No,
substitution.
that's sound economics, so it makes sense.
All right. Okay, we leave it at that. I guess import substitution is not immediately that big a threat that the Reserve Bank is worried about. Let me come to the other conclusion that you had. The dollar, what can replace it? You spoke about euro and the yuan as potential replacement candidates. What about Bitcoin?
No. Bitcoin, so when you think of Bitcoin, there is the technology that goes behind Bitcoin, which the financial world is very excited about. But besides that, it comes close to gambling when you bet on the Bitcoin. I do not believe it will be, I'm making a prediction, it will ever be a medium of exchange like the way the rupee is or the dollar is or currencies in the world are. I do not see how that's going to happen because the minute there's a real threat of that, regulation will step in. So right now it's basically being used to finance activities that have not the best tags on them. So it is, I mean, in my opinion, it's a speculative bubble at this point. There is some fundamental value to it in terms of the technology, but the pricing seems way out of line.
Okay. Well, as a matter of fact, over the past 3 months, in just one quarter, the market capitalization of Bitcoin has doubled from around $200 million. It's now over $400 million. Several countries are accepting taxes in Bitcoin, some Scandinavian countries. And the United States has allowed 2 markets to have Bitcoin futures. And if Bitcoin futures are allowed, obviously leveraged positions will be taken by financial institutions very legitimately. So is there not a future that Bitcoin is taking more and more space as a medium of exchange?
No. The US likes to have a policy where it's not interfering directly in kind of what assets can be traded and all of that. And so the Bitcoin is another speculative asset, and it is what it is. But there's heavy regulation of there is much more regulation of the banking sector. That's what they care about, and they'll pay attention to it. The minute it looks like it's going to impede on any central bank ability to control inflation or GDP or growth in the economy, they're going to clamp down. It's already banned in China. There are many countries in the world that have banned it. I do not see it becoming a medium of exchange, the way other currencies are.
Okay, so it's only tolerated as much as horse racing, you think? Well, what's your sense, Mr. Raskina? Do you think that Bitcoin is going to take away at least some space that gold is occupying as a hedge against inflation?
No, absolutely not. Gold has a very emotive kind of link to it, which takes people on the emotional level as much on the investment level. And when it comes to any currency substitute, what is a currency? A currency is a piece of paper which ultimately is a confidence scheme. And how much confidence do you have in the issuer of that currency to maintain its value and to safeguard your savings? None of that, to my mind, applies to Bitcoin. So it's a nice game to play. I have friends who are dabbling in it myself, but I don't see it ever growing too much.
You have rich friends. Well, what's your sense, Mr. Malik? Bitcoin is just something, a passing pastime?
If I remember my economics right, there are two types of currencies. One is a promissory note and one is a legal tender. Bitcoin is neither of them. Okay, Scandinavian countries accepting it as trade is a close proxy. It's yet to emerge as a legal tender, and definitely promissory note it is not. I don't know whether it will be a penny stock or a great stock. That I wouldn't be able to say. But until and unless it has some economic fundamental behind it which gives it the confidence or a legislative confidence, otherwise the currency cannot survive. That is a very strong feeling. It's after all, currency is after all a medium of exchange. It started with barter.
It is a medium of exchange. You can buy Amazon products. You can buy Microsoft products.
Yeah, but you cannot exchange between you and me.
Okay.
See, end of the day, it's not that digital currency.
No, it's not arrived there. I agree.
That is
I agree. But money is
it can be easily hacked into.
Yes.
It can be hacked into.
There's no safety.
The blockchain can't be hacked into.
You can lose all of this so-called Bitcoins that you have by a hacker.
Okay.
See,
all right.
A currency would be accepted as a currency when it can be used for trading all around, not only in the digital world. It should be able to also permit trade between you and me. So until and unless Bitcoins comes down to that level, it's not possible.
Yes.
And that requires a whole lot of confidence between both of us in accepting Bitcoins.
Okay.
Today, when it moves from $5,000 to $15,000 and comes back to $3,000, it's very difficult for you to estimate your wealth. And the wealth effect of consumption would not play out.
Okay, fair enough. At the moment, it's not a threat.
Thank
But
you.
maybe next year, in the next Exim Bank lecture, we perhaps would have pushed it away as another instance of gambling, or maybe we will be taking it more seriously. Only time will tell.
Maybe we have a topic for next year's annual lecture.
Yes. Well, cryptocurrencies perhaps. But okay, let's just finish this round of our discussion and get to a lot of questions that have come from social media as well. Just a word, 2018 generally for India, growth better?
Absolutely.
Growth and exports better?
Both, no doubt about it.
Gita?
Sounds like that's the only answer they want to say. Yes, yes.
Mr. Malik?
Yeah, I hope so.
Okay. Well, with having ushered in 2018 with that kind of promise, let me turn over to the other questions that we have got from social media. This is, I would assume, addressed largely to Gita because it's flowing from the lecture. What strategies can be adopted for internationalization of the Indian rupee?
Well, I think the most important thing that India can get right is in terms of developing its own financial institutions, making them very strong, consistently delivering on monetary policy, making it look like, that they can keep their inflation targets, that the value of the rupee will stay stable, it will not fluctuate for strong reasons. So sound macros is the first thing. Then, of course, there is the second bit, which is what China is doing, which is going around the world and convincing. So what China does is that it's going to its. You want me to use the mic?
Yeah. You can still be heard.
Okay. Thank you. So what China is doing is going around the world, and particularly African nations, and basically telling them that, well, if you invoice your trade in yuan, we'll give you loans at a very cheap rate in yuan. So that's kind of one of the ways that they're trying to do to internationalize it. I don't think there's any rush at all for India to do something along those lines. Keeping its macro fundamentals sound will, over time, when it grows into a much larger economy, will naturally usher in the rupee as a global currency.
Okay. Mr. Raskina, are there any signs that we are trying to increase more rupee trade? The point that Gita was talking about, all our exports, or a large part of our exports, are invoiced in dollars. Is there any move at all for rupee exports?
There have been moves which have been study groups to set up, seems to be working, study groups to examine whether Indian exporters might be willing to invoice in rupees and what that might require. Now, nothing technically stops an Indian exporter from invoicing in rupees.
But will anyone buy?
That's exactly the point, because the importer then has to have some means of hedging his home currency against the Indian rupee. There is little or no hedging market for the Indian rupee overseas, for the very good reason that the rupee is not convertible on the capital account. You can't really have a hedging market developing in an offshore center. So how does the overseas importer hedge his risk? Secondly, the Indian exporter has got more or less used to a rupee that has been steadily depreciating over time. In his pricing, and this comes back to Gita's lecture, in his pricing he usually builds in a certain amount of depreciation. So that then gets sacrificed. If you are going to use your home currency, which is not immediately hedgeable internationally, then you have to offer some kind of incentive to your buyer to get him to take your home currency. What is that going to be? A cut in price? Some amount of discount? We've looked at all the possible angles, and the conclusion has been that as of now, it's simply not workable.
Okay, so sound macros and capital account convertible currency. Do you see, would you want to take a jab at this question?
I agree overall, except that I can only say that in exceptional cases we have done it. Like I think the Iran trade is being done in India in Indian rupee. But that is primarily because Iran is barred from accessing the US dollar, and no one from Japan or Europe also gives anything to do with Iran. So it could be either Chinese yuan or Indian currency, and since it's Indian currency doing the trade, so we can push through an Indian trade. But it's just situations like that, when a country is forced to rely on you and accepts.
Yeah, which occurred to me that actually Iran could have worked its way around sanctions if Bitcoin had existed. They could have accepted Bitcoins for
I
oil.
don't know whether the ruling order would permit that.
Okay, all right. It was anyway hypothetical. Well, China has the second question. China has emerged as the largest oil importer. There are also reports of China negotiating with Saudi Arabia to trade in the renminbi. Do you think this can position the renminbi as an alternative for alternative currency for energy trade and therefore end dollar hegemony?
This is what I just said, which is this is kind of what China is doing, which is going around and in exchange for cheap yuan loans, they are convincing people to invoice in yuan. This is very similar to what the U.S. did back in the day when it was taking over the pound. Okay. So this is this very similar strategy. So they clearly want to make their currency unhedge the dollar. But the Chinese are always on a slow burn. I mean, they're not in any big rush to shake things up. They have their horizons are quite long term.
Okay. Well, now this is a question which is an erudite question which speaks to your conclusions. Even if there is an alternative currency, like say renminbi, the typical MFP model will still not be applicable, right? Because producer prices will still be denominated not in dollars,
yes,
but in renminbi.
Yes.
So don't you think the advocacy of freely floating exchange rates will still remain invalid?
Oh, yes. That's what I said. I said there was a dominant currency before the dollar, and that was the pound. There's the dominant currency now, and there'll be another dominant currency. There was never a time when the MFP was the relevant paradigm for the world.
Okay. Can there be a use of a new global currency which is disconnected from individual nations? Again, Bitcoin.
No, okay, you have to get over Bitcoin. I'll give you another example, which is the SDR, which is the IMF's unit of account. Nobody's gambling on that. But it is indeed one of those cases where if for some reason the world converged to pricing their goods not in rupees, or not in dollars, but instead in the SDR unit of account, then given that the SDR is a bundle of currencies, at least there will be some insulation from very direct movement with the dollar. So I do think like a country like India would certainly benefit if the world was doing SDR invoicing as opposed to dollar invoicing, because there's some hedge from different exchange rate movements. And that's possible.
Okay. But it's not in the foreseeable future that the dollar is shaken from its position, is it?
No, not in the foreseeable future. I mean, I know that the IMF is thinking about the SDR being used more in global transactions, so I'm not sure where they're going with it, but it's something that they are thinking about right now.
Well, another China-related question. Even if China in the near future tries to move towards a yuan-denominated oil benchmark, how difficult is it going to be for nations to switch to it, given the Chinese regime of tight control over currency, which may lead many global players to assume the yuan-denominated oil benchmark would be firmly under Beijing's thumb?
Yeah, so I mean, so these are exactly the reasons why it's not going to be an easy switch. It's not going to happen that easily for all the reasons that you just mentioned.
Okay, and this is something which is after all our own hearts, and I asked you this question earlier today. What impact will corporate tax cuts in the US have on the INR and other EM currencies? US multinationals keep cash surpluses overseas in international hubs or in the country of operations. A move back, coupled with the interest rate trajectory which the Fed has indicated, may create weakness for INR EM currencies, do you think? What are your views? What will be the impact? Okay, what are your views on this?
Yeah, so, you know, people often refer to this fact that there's all this money that's sitting outside the US that is not being brought back in. It's not like actually there are chests of money sitting outside the US that people have to bring back in. They're basically money that are sitting in financial institutions in the world. And several of these financial institutions are based in the US. So, I mean, unless we have an argument to say somehow that the portfolio investments of these companies is going to dramatically change, and I have no reason to think that's the case, I don't expect to see a big, you know, exchange rate movement like during the taper tantrum or something of that kind. So yes, I think all the forces move towards a stronger dollar, but I don't see a big spike in the exchange rate.
No, we were expecting it, but the dollar index stays at 93.94. Hasn't changed much since the announcement and the passing of the bill itself. Well, there's just one more question on BRICS countries. They are proactively trying to promote mutual trade in their national currencies. Will their initiatives undertaken by this bloc play any role in the pluralization of the number of trading currencies?
Certainly it helps, but I mean, look at the facts. The euro, which in terms of, you know, the countries that use the euro as their own currency, is only second to the US and very close second to the US. But it hasn't been able to unseat the dollar. But it has certainly helped for euro countries' inflation because their trade with each other is now euro-based, so that has been very helpful. So certainly blocks of that kind will help. And the question is which currency. It's not as if all the emerging markets are using the same currency. It's not going to help everybody. So, you know, there's always some marginal upside to it. I don't see a big upside.
Okay. Well, that ends the questions from social media. Can we wind up, or do we have to take any more questions? Okay, from my side, thank you very much, Mr. Raskina, Gita, and Malik for joining us.
Thank you very much, ma'am. Thank you.
Thank you, Madam, for conducting the panel discussion as well as the question-answer session. And before you leave, I just wanted to inform, and we are very happy to tell you that at Exim Bank, we have broken with tradition and discontinued the practice of offering bouquets of flowers to our guests. This is on account of, you know, not just they are perishable, they are also, you know, it's from the environmental angle as well. Instead of that, we thought it better to do a different initiative which would make a difference in the lives of some people. We have partnered with the Akshay Patra Foundation, and we have made donations in the names of our guests today. Firstly, I request our Managing Director to present a certificate to Professor Gita Gopinath. We have donated a sum equivalent to midday meals for 20 children for a period of 1 year. May I request our Deputy Managing Director to present a certificate to Ms. Lata Venkatesh, and we have donated a sum equivalent to midday meals for 10 children for a period of 1 year in her name. I now request our Deputy Managing Director, Mr. Malik, to propose a vote of thanks.
Thank you, Vikram. Thank you, Professor Gopinath. Thank you, Madam Lata, for for the great way in which you have conducted the program. It is actually a very rare occasion that you get to hear of certain changing ideas, something which is absolutely a fundamental shift, something which changes the way you think. If I remember right, of course it was many, many years back, when I had read the preface of general theory, and in that Lord Keynes had commented that he's working on a theory which, if not today, maybe in the span of next 10 years, change the way people think about economic development and how the world behaves. That was perhaps a letter he wrote to George Bernard Shaw. Now, I don't know, future would have to say whether this theory is as fundamental as the general theory, but I wish it was that, because it has been really a wonderful insight, madam. We have all been brought up in the theory whereby the MFP theory had operated. In fact, today afternoon during lunchtime when we were discussing economics little around, we were all glued, or at least I was glued to that particular theory. You have today taught us an alternative way to look at things. It's very worrisome, because actually changing mindsets is perhaps the biggest problem. And that is something which would be a challenge definitely to me. I don't know about all others. I hope India is lucky to have many others who can change mindsets quickly and put things into focus more easily. But it was really a very revealing thing. And the policy implications, especially where you arrived at, is really fundamental. If what you have told us, I am leaving aside the other things of inflation, etc., etc. What you have told us is an absolutely fundamental change from a laissez-faire economy of free-floating exchange rate to a managed float, and countries which have performed managed floats or carried on managed floats for many years have perhaps done better than countries which have performed free-floating exchange rate, especially our illustrious neighbor. So that is one important thing. The other very important thing is that you have taught us a new way of looking at it. We in Exim Bank will definitely try to look at it, and we will definitely hope that in the days to come, we will use this lecture today as a very fundamental lecture delivered in the Bombay intellectual space under the guidance of Exim Bank and by Professor Gopinath, which would change the way the bankers and the economists of this country think. It is a wonderful occasion that Lata is present here to propagate this, because Lata is the best known commentator in the Indian scene today. It's always a great pleasure listening to you, madam, whether it's the budget analysis, or whether it's Raghuram Rajan on the stage, or whether it's the stock market movement. We always used to look forward to what you have to say. And most of the days we go home concluding that whatever you had said was right, because that often helps us. So, with all these words and the great amount of questions which we had from the audience, I am sure it has been a wonderful evening for all of us. Thank you, Professor Gopinath. Thank you, Lata. And thank all of you for making this a very special occasion. Exim Bank, thanks everyone for making this Commencement Day annual lecture a big success. Thank you very much.